I want to just speak for just a few minutes to set the conversation, and then Annie and I will kick off, and she's going to moderate the discussion, not just between the two of us, but also hopefully with all of you. So I always like to ask audiences to do me a favor, and that is show me respect by asking me your toughest question when we come to you. Because if you're thinking of a tough question, there's a good chance somebody else is thinking of that same question. I'd much rather get it out in the open and address it than have you wander off not having your questions answered. So I've been at the Minneapolis Fed since January. Let me just spend a moment and share what the Federal Reserve does. Some people understand it, not everybody does. The Federal Reserve is the central bank of the United States of America. And most countries have central banks, and our job is to manage interest rates, manage short-term movements in the economy to keep employment full and to keep inflation low, and to respond to financial crises and to oversee bank regulation. Now, one thing that's different about our country's central bank is that our country's central bank is distributed. Most central banks around the world are just concentrated in the capital city of that country. But 100 years ago, when Congress said we need to have a central bank, they said we don't want all the power concentrated in Washington, D.C. We want some of the power in Washington, the rest of the power spread out around the country. So we have 12 regional Federal Reserve banks. The Minneapolis Fed is considered to be the 9th Federal Reserve Bank. We represent the 9th district. That's Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. And our jobs at the Minneapolis Fed are to get to know our district really well, understand what's happening in the economy of our district. And when we go back to Washington, I go 8 times a year to set interest rates for the United States of America. We can bring back to those discussions what's happening firsthand in the 9th district. And so that's why we're here. That's why we have a bank in Minneapolis. And it's really important to me and to all of us to get out across the 9th district to hear from all of you firsthand what's happening in your neighborhood, in your community. So I'm spending today and tomorrow in Rochester, my first time here, just getting to know what's happening in the community, meeting with citizens, meeting with small businesses, meeting with educators, meeting with civic leaders as well. So that's a little bit about the Federal Reserve. Now, Annie and I are going to talk about a lot of things, but one of the things we're going to talk about is a big initiative that I announced at the Minneapolis Fed shortly after joining, which is we've launched a program to try to end the problem of too big to fail banks. So when I was at Treasury in 2006, 2007, 2008, 2009, we had that terrible financial crisis. And I'm the guy who bailed out the banks. Let me just cut to the chase here. So you hated that? I was the guy in charge of that. And I did it for both Presidents Bush and President Obama. I hated it too. Why did we do it? Because the U.S. economy had a massive heart attack. And if we had allowed all the biggest banks to fail, instead of a terrible recession, we would have been in the Great Depression. It's like if you have a big heart attack, that can kill the patient. It's that serious. Well, that's what we faced in 2008. That's why Republicans and Democrats came together to step in. But now, having climbed our way out of that, we got to make sure this never happens again. We need to make sure policymakers are never put in that position again. And so, having lived through that crisis, I've looked at the regulatory reforms that followed, and my gut tells me they haven't gone far enough. That if there's another crisis in a decade or 20 or 50 years from now, this could happen again, and I don't think that's a good answer. And so in Minneapolis, what we're doing is we're convening experts from around the country to study, look at the problem of too big to fail, what are some of the solutions that are out there, and by the end of the year, we've committed to coming up with our plan to end too big to fail that we're going to present to the public. And then at the end of the day, it's up to the public to decide, have we done enough? Should we do more? Do they like our plan? But I don't think it's okay to give people a false sense of security that this can never happen again, because I think it can happen again, and I think we should do more. So we're bringing experts together. Our first symposium was April 4th. Our next symposium is May 16th, so 2 weeks from 2 days ago. And it's all open to the public. You can go onto our website and look at it. It's live streamed. All the materials are public. The press is there. We want to engage the public as much as possible so that you all are as informed as you can be, because at the end of the day, the American people need to decide, have we done enough or should we do more? So that's part of what we're going to talk about today, and this is a big initiative. And I'm proud that the Minneapolis Fed is taking a national leadership role in this. And by the way, it's not just me having expertise in this. It turns out the Minneapolis Fed has been working on these issues literally for decades. So there's a great body of expertise that we're tapping into, as we charge forward on this important initiative. And so we're going to talk about that. We're going to talk about whatever else Annie would like and whatever else you would like, but I wanted to kick off with that background. So I'm going to sit down now and answer her tough questions.
And to President Kashkari's point that he'd like you to ask tough questions, I've, in preparation for this, watched quite a good deal of footage of him at meetings like this, and he doesn't seem to flinch very much at those tough questions. So you should feel confident in having respect shown back to you if you care to ask some tough questions. So I wanted to just, because I think, not everybody in the room is maybe all that familiar with what you're doing. I mean, you gave a few hints here at the Too Big to Fail initiative. A couple of the ideas that you've laid out, I know this is a work in progress, but you've talked about breaking up banks, taxing leverage, and regulating banks like a utility. And I wonder if you could kind of explain what those concepts mean, first of all, because they seem like they're the big ones on the table right now.
Sure. So right after the crisis, 2008, 2009, Washington rushed to reform the regulations of big banks. But in my opinion, they took the transformational solutions off the table because people thought they're too radical. And we need to just stabilize the economy. So they just put small measures to keep the system the way it is. Well, my view is we need to give those transformational solutions real consideration. Now's the time when the economy is stronger to really consider those. So break up the banks is one of those, and it's kind of what it sounds like, which is you put a cap on bank size, and you say you can't have these multi-trillion-dollar banks. They need to be a lot smaller, because if they're smaller and if one of them were to run into trouble, it's going to be less damaging to the economy. And by the way, let me just back up for a second. Think about the tech bubble in the late 90s. We had this giant boom. Remember that? Then we had this crash in 2000. That was devastating for Silicon Valley. But it didn't risk the whole U.S. economy. He didn't plunge us into the Great Depression. And so we need a financial system that can make mistakes like that without bringing everybody else down with it. And so break up the banks is one of the options that some experts, we had a professor from MIT named Simon Johnson who came to Minneapolis and presented his ideas to break up the banks by basically putting a cap on bank size and forcing banks to shrink to meet that size requirement.
So is the idea then if loans go bad, if you have a multiplicity of banks, you don't have all of the nation's loans tied up in just a handful of them, then loans go bad at a couple, you have all these other lenders still that are...
Yeah, the risks are not so concentrated. So think back, you're not going to, most of you won't remember this, but in the late 80s, we had the savings and loan crisis. We had 1,000 little banks around the country that failed. They were little banks that represented actually a pretty small share of the overall banking assets. It was really tough on those communities, but again, it didn't bring the whole U.S. economy down with it. And so the proponents will say, if banks were smaller and less concentrated, they could make mistakes and not bring the whole economy down with it. And by the way, we at the Minneapolis Fed have not yet chosen which of these ideas we think is best. We're studying all of them. That's going to come together in our solution at the end. So number one that we looked at is break up the banks. Number two is, and I'm doing them in a different order than you did, is treat them like utilities. So think about a nuclear reactor. Well, nuclear power is an important source of energy in our economy. But you all know if a nuclear reactor were to melt down, it would be devastating for our communities. And so what do? We put a lot of regulations around them to make it so it's almost impossible for one of these reactors to melt down because it's so damaging to society if it were to happen. So there's another group of experts who say, you know what, we should treat big banks like that. Let them be big. Let them be as big as they want to be. But put so many regulations and controls around them that they virtually can't fail. And in this case, it's put a lot of capital in them, which is the extra buffer that they have against losses in case they make bad loans, in case they make mistakes. Now, banks aren't going to like that because if you make them hold a lot more buffer, then their profits will be lower because the more buffer you have, the less profits you have.
And specifically buffer in the form of equity from shareholders who don't get paid back. It's just, they just lose their money, right?
Correct.
It's different from creditors who would have to,
they'd
have an obligation to, right?
So think about your own mortgage in your house. If you put 20% down on your house, you've got a bigger cushion if your price declines than if you only put 5% down on your house. And so this is the exact same concept in a bank. If you make the bank have a bigger, quote unquote, down payment, they're safer. They're less likely to default on that mortgage, on the loans on their debt that they owe to people. So that's the second option. Now, one of the problems with both of these options is that if you make the banks really safe, you might just push the risk out of banks and into hedge funds or insurance companies, or you may have heard of this term called the shadow banking system, the non-banks. So there's another group of experts who say, a better way to approach this is if you tax debt in the financial system. Because at the end of the day, it's the leverage that makes all of these institutions risky. So if you tax debt, whether it's at a bank, or it's at an insurance company, or it's at a hedge fund, then you don't really care where the risks go because you're reducing risk all across the financial system. So that's a third option. And we've actually added a fourth, which is some experts have come to us and said, hey, you should consider a fourth option. And that is if a bank runs into trouble, maybe we can have better tools for dealing with that without having to turn to the taxpayers. And we call that resolution authority, an alternative way of resolving a failing bank. It's pretty technical, but it's a fourth option that we're looking at. We looked at breaking up the banks and turning them into utilities in the first symposium. In a couple of weeks, we're going to look at this taxing leverage option and this resolution option as well.
One of the big themes that you've gotten at in your various speeches on this is the problem of regulatory capture, where the regulators who are overseeing these lending institutions kind of get too cozy with the people that they're overseeing. How would the proposals you're laying out obviate that problem? Does that go away?
I don't think that these solve that directly. It probably reduces the risk or the cost of that, because if the banks are fundamentally safer, then if the regulators are not as diligent as they should be, they don't cause as much damage to the economy or to society. So this is a problem all around the world, where you have government regulators. It could be regulating banks. It could be regulating any kind of business. It could be regulating a hospital. And they're in there every week or every month or every year, and they get to know the compliance officers, and they work together over years. They become friends. They're not bad people. They're trying to do their best, but they end up not being quite as diligent as they probably should. And, I experienced that in Washington. So when I was in Washington running the TARP program, we needed all of the banking regulators around the country to make recommendations about whether or not their banks should receive government capital. Well, we got all these applications in with all of these recommendations saying, hey, 2 thumbs up. And when we looked at these applications, we said, what are you talking about? So we created a council of the regulators where they had to test each other's assumptions. And only if their peer review yielded a unanimous vote yes did we go ahead and make the investment. And so regulatory capture is a real issue. It's a tough one, but we need to make sure that the banks themselves are able to fail without bringing down the whole economy.
Just to elaborate on that point, another example that you had brought up when we were talking about planning this out today was how banks can actually have some say in choosing which agency oversees them. I wonder if you could explain that, because I think that's probably something good for people to know.
Yeah, so banks, so there's regulatory capture, which Annie just asked about. There's also something called regulatory arbitrage, which is if you run a bank, depending on the size of the bank, if you're really big, then you don't have a choice. But if you run a mid-sized bank, you can choose if you want the state regulator to be your regulator, if you want the Federal Reserve to be your regulator, if you want the OCC, which is called the Office of the Comptroller of the Currency. That creates a weird incentive, because now all of a sudden regulators are competing for you. Because the more banks they can supervise, the more staff they can hire, the more money they have to maintain their operations. And so there are people out there who say, we ought to consolidate this and only have one regulator of a given size bank so that they don't get to pick and choose who they want. Now that's a much bigger issue, and it's a politically charged issue because each of these regulators fights tooth and nail to protect their turf. And so it's a problem.
Your predecessor, Gary Stern, a couple presidents back, at the speech you gave at the Brookings Institution, suggested, I guess, that these kinds of issues around regulatory capture maybe are still he'd still worry about them, and he thinks that maybe a better solution for pursuing some of the problems that you see would be addressing them through corporate governance structure, so getting the boards of banks to impose, stricter requirements. It doesn't seem like that's something that you think would be effective enough, and could you explain why?
Yeah, I don't think it's enough. I'll tell you why. Societies, human societies, not just American societies, human societies are prone to mass delusions, where we all believe something. And turns out we all believe something, and then it turns out when that thing's wrong, it can be very damaging to society. So most recently, most of us, myself included, believe that home prices only go up. If you look around the country, they only go, if you look over American history, they've only gone this way. Certain regions have gone up, some have gone down, but if you look nationwide, they only went in one direction. And that was a fundamental belief that we all implicitly shared. Well, it turned out that was wrong, and then we had the terrible recession and the terrible financial crisis. So I don't know how you get a board of directors of a bank to be smarter than the rest of society. It's very hard to legislate wisdom. Number one. Number two, if you look at the banks, the riskiest investment banks on Wall Street, Bear Stearns and Lehman Brothers, their management teams and their boards of directors had the biggest ownership of their own institutions. So their incentives were aligned. They were well incentivized not to take crazy risks because it was their own money that they were betting with, in addition to potentially taxpayer money. And yet those were the first two firms to fail. And so again, we can't just count on either regulators or boards of directors or company managements to be wise. We have to assume that they're going to be fools, and then ask ourselves, when they're fools, do they risk bringing down the whole American economy? And let's design a system that's robust enough. Again, if you went to Silicon Valley, in the tech bubble, each of those little tech companies, remember toys.com and things like eToys, they had boards of directors looking out for their shareholders. They were all fools. But they didn't bring down the economy.
You obviously have a lot of strong opinions on this, and you are kind of, ruffling some feathers with some of your thoughts, such that, even former Treasury Secretary Larry Summers has said that he's called your speeches sloganeering, and I think maybe didn't like that you kind of came out punching, first month into the job. Are you worried that, maybe not having a more collaborative approach within the Fed system is going to cause a problem for this initiative? No, I'm not. People give speeches all the time, and you can give a speech, and maybe somebody pays attention for a day, and then the next day everybody moves on and forgets about it, and what have you accomplished? This is such an important issue that my goal was to try to help catalyze a very serious national conversation about this issue. Because at the end of the day, the American people need to decide, are they okay with the risk that we're taking, or do they want us to do more? And so to me, it was critical that we kick off this national conversation. And so I make no apologies for coming out punching, because I'm happy that we're having the conversation. I'm happy that the banks are mad, because that means they're taking us seriously. And by the way, in the symposiums that we're having in Minneapolis, all sides are represented. We're putting all sides out there, and we're having a really robust discussion, and we're learning from one another. And that's what I think we need to do. And so, my old boss, I used to work for the Treasury Secretary, Henry Paulson, and he liked to joke that, it was only partially a joke, that 60% of Americans are against torture, but 90% were against the TARP. Okay? And I'm the guy who ran the TARP. And so I'm long past the need to be loved. I would much rather be honest with people about what we're doing and what the risks are. And if some people are mad about that, I'm fine. I sleep well. I want to ask about a couple other things apart from the Too Big to Fail symposiums you've been doing. And in a few minutes, would love to open it up to some of your questions as well. So get your pencils sharpened. One of the things, employment, we've got this unemployment rate of 5%, seems pretty good. But the number of long-term unemployed people, those are people who've been out of work for 27 weeks or longer, sits at 2.2 million, and that's not really changed very much since, I think, like June of last year. That's 28% of the unemployed. I think maybe you mentioned in your opening speech that the Fed has a dual mandate of stabilizing prices and maximizing employment. And I just wonder what could be done for this particular problem that seems intractable and isn't really, I mean, it's better than it was a few years ago, but still seems to be a big problem.
Yeah, it's a big issue that we pay a lot of attention to. So as Annie was suggesting, we've got this headline unemployment rate that you read about in the paper that's 5% nationally, but it doesn't include people who've given up looking. You've got a numerator and a denominator, and if people just give up looking, then they're not counted. Now, there's actually some good news on this front, which is a lot of economic experts thought once somebody was unemployed for a long time that they'd be lost from the job market. The long-term unemployed would become the permanently unemployable. That's a huge cost to them individually and to society as a whole. Well, our economy has actually been creating a lot of jobs in the last few years, and we're creating jobs right now at around 200,000 per month. But our headline unemployment rate has not been moving. Now, how do you create 200,000 jobs a month and the unemployment rate isn't going down? That's because some of these workers are re-entering the labor force, re-entering the job market. That's a good thing. It's been a surprise. We didn't think it was going to happen, but it is happening. And so my view is we need to allow that process. While inflation is low, we need to allow that process to continue, because if we can bring people back into the labor force, that means they're not needing to rely on unemployment or disability benefits. They're able to be contributing members of society, which is good for them, good for their families, and good for all of us. And so it's a tough problem, but hopefully we're making a dent on it.
And how confident are you in the health of the economy right now? We've had various kind of not so great reports over the past few months. This ADP employment report out this morning was kind of lackluster. Various analysts have prophesied recession this year. Do you see any possibility of recession within this coming year?
You know, there's always, I hate to say this, but every year there's always a possibility of recessions. And one thing economists are notoriously bad at is predicting recessions. And so we have staff of economists all around the Federal Reserve System, and they're all looking at this and looking at the data. Usually we know we're in a recession after we're in the recession, as opposed to being able to tell you when it's going to happen, unfortunately. So our base case is not that we're going to be in recession this year. Our base case is continued moderate economic growth. But we need to get the economy moving again. One of the really tough challenges that we've faced as a country over the last 3 or 4 years is that our productivity has really slowed down. And that means like how much can we produce, how much growth for the same number of people we have working. So we're putting a lot of people back to work, but our economic growth overall isn't climbing very fast. And that implies that we may be in for a slower growth period in the future, and we don't fully understand why that is, how much of it's real, how much of it might just be noise in the data. So our outlook right now is for moderate economic growth. Our base case is not that we're going to be in a recession, but we're watching all the data very closely because we want to make sure that we can keep the economy growing again. And by the way, some of these things that are happening in the American economy are not unique to America. If you look around the world, Europe and the rest of the world is also experiencing slow economic growth and slow productivity growth. And so there's some macroeconomic forces that are global in nature that we're trying to understand that we don't have full control over.
With the hindsight of a few months, was it the right thing to raise interest rates?
I think, 25 basis points. So after many years of basically zero interest rates, in December, before I joined the Fed, the Federal Open Market Committee raised interest rates by 25 basis points. That's a small move. Going from 0 to 25 is slamming on the brakes. And so I think we learned some from that, what the effect would be on the economy. We've since paused, and we'll see when we raise again. I think there's great interest in getting us back to a more normal interest rate environment, but we want to do it when the economy can sustain it. If we were to just raise rates really aggressively, we would be slamming the brakes on the economy, which I don't think anybody thinks is the right thing to do right now. So we're watching the data, and I think you're going to see us move when the data allows it.
It does seem like there's a lot of divergence of opinion on the interest rate question among the Fed presidents. Is that a good thing, or is it good to have that multiplicity of opinions, or is it sending a confusing message, do you think?
Well, I think it's an honest message, which is there's diversity of views because go back 100 years ago. Congress, in their wisdom, Congress doesn't get everything right, but I think they got this right. They said they want a diversity of views around the Federal Reserve, around the country. And so you're seeing that, and you're seeing that diversity, and sometimes it adds to some confusion. But I think overall it's better that we're having a robust debate rather than pretending we have all the answers when I'm sharing with you we don't have all the answers. And we're looking at the data, and we're going to do our best as we get new information.
One of the things that your researchers at the Minneapolis Fed have been concluding over the past couple of years is that some of the regulation that came about as a result of the crisis is overly onerous for smaller banks. And one of the more amusing criticisms that I've seen of you is that somehow you're in the pocket of little banks now with your, with your comments.
I'm owned by the little banks. That's yes, fascinating.
Exactly. I wonder if you could unpack that a little bit, what you would do differently, what you would free them up from, and what benefit would that be to people who want to borrow money?
Sure. So coming out of the crisis, there was all this attention on too big to fail. They took the transformational options off the table, but they said, let's just double up the existing regulations, basically. But it didn't just hit the biggest banks. It hit all the banks. And so if you're a little bank and you need to hire an extra lawyer or an extra compliance officer or a few more, that's pretty expensive for you compared to if you're one of the trillion-dollar banks that can hire an army of lawyers and accountants and compliance officers. So you're seeing a lot of little banks saying, gee, we just can't afford to compete anymore. We're going to have to merge to get some scale to afford these regulations. And so the perverse thing that's happened is the regulations that we've put in place now have made the too big to fail problem worse because they've given a bigger advantage to the big banks relative to the small banks instead of taking away their advantage. So my hope is that if we can really come up with reforms that work for the biggest banks, then maybe we can relax some of the regulations that are burdening the small banks who don't pose a risk to our economy if they were to make mistakes and run into trouble.
Why don't we open it up to some of your questions? There are microphones circulating here.
Are you saying that the Dodd-Frank bill is a bust? Number one. I guess number two is, can you sort of relate the Glass-Steagall Act and the Dodd-Frank bill and put them in some perspective, please?
Sure. Well, Congressman Barney Frank gets mad if I speak ill of the Dodd-Frank bill. But I'll say this. I wouldn't call it a bust because I think some good has been done. So banks today do have more capital than they used to. They have deeper sources of liquidity, so sources of funding. And the Federal Reserve is putting the biggest banks through stress tests, economic simulations to see if they could withstand a shock. Those are good things. My concern is that it hasn't gone far enough if we have another major crisis like we had in 2008. And so I think it has done some good. My gut tells me it has not gone far enough, and that's what we're trying to study. But let's go back for a second. So you had the Glass-Steagall, which was passed after the Great Depression, which said you have to separate commercial banking, which is making loans to businesses and to families, from investment banking, which is like underwriting securities, bond offerings, stock offerings, IPOs, mergers, things like that, trading of securities. You have to keep those separate. Well, in the late 90s, they passed a law, President Clinton signed a law saying you don't need to keep those separate anymore, and that allowed these financial supermarkets to be born. Citigroups and JP Morgan and Bank of America, Merrill Lynch, being able to do everything one-stop shop. There's no question that the repeal of Glass-Steagall has allowed banks to get bigger than they otherwise would have and more complex. And I think size and complexity are some of the sources of this risk and the systemic risk. Personally, I don't think just simply going back to Glass-Steagall will solve the too big to fail problem. I think it would do some good, but I don't think by itself it's enough to solve the problem. I think we need to look more comprehensively at how do we address this problem. Keep in mind, Glass-Steagall was passed in the 30s, right? Our financial system has evolved a lot over the ensuing 80 or 90 years. And so we need regulatory reform that can deal with today's financial system. But I give them a lot of credit. Their reforms worked for 80 years. That's pretty darn good. Thanks for asking it.
Question over here?
Just interested in your thoughts. both pro and con about the extensive use of quantitative easing over the past several years, the effects that, as you see them?
Sure. I think the Fed, the question was about quantitative easing. So the Fed can manage short-term interest rates, but after you've already put short-term rates at zero, the question is the Fed out of tools? And the answer was no. The Fed brought great creativity and said, you know what, we can buy longer-term government bonds and mortgages. What does that do? It drives down borrowing costs. So banks will borrow from one another overnight, so very, very short-term, literally overnight. You and I, if we take out a mortgage, we might expect to be in that house for a decade. We may pay off that mortgage over 30 years. So if you can drive down longer-term interest rates, you can reduce borrowing costs in the real economy, not just in the financial sector. And so I think the Fed showed great creativity and using this thing called quantitative easing to drive down longer-term interest rates. I think it was the right thing to do to try to get our economy moving again coming out of this financial crisis. You know, financial crises, like I said, it was like a heart attack. The good news is we got the patient to the ER, we did emergency surgery, and we stabilized the patient. But like a major heart attack, we were still in for a long, hard recovery. And that's what we're still digging our way out of. And so I think quantitative easing was the right thing to do to try to boost that recovery, recognizing it wasn't perfect and it wasn't a complete solution.
There's a gentleman right here. Oops, pardon me.
I have 3 questions. I'll limit it to 1 right now. You used the word resolution. Is there a nickname for that, like bail-in?
That's sometimes called that.
And would you suggest to us, under what hypothetical situation would a bail-in occur? Who would motivate it?
Sure.
And why would it even be necessary, as it apparently has been in a few countries around the world?
So the concept of a bail-in, so a bailout, what that means is big bank runs into trouble and you're afraid that if it collapses, it'll bring down the economy. So you have to turn to taxpayers to use taxpayer money to stabilize the bank. That's what we had to do in 2008. The idea of a bail-in is, well, banks have capital, so that's the down payment on your mortgage, and then they have debt, that's your mortgage, that maybe you could convert some of that debt into equity if it runs into trouble. So those debt holders are very unhappy, but you don't need to turn to the taxpayers for the funding. You just reduce the liabilities of that bank because those bondholders are now going to get stock. They're not going to get their money back. So it sounds very elegant in concept. Problem is it's never worked in the past. So I'll give you an example. Fannie Mae and Freddie Mac, these big mortgage companies, they have a lot of debt, trillions of dollars of debt. Well, in the early 2000s, they began issuing something called subordinated debt. And the idea was this is riskier debt. If they ever run into trouble, we're going to simply convert that debt into equity to recapitalize them. Well, what ended up happening in 2008 is the system was too scary, too fragile. The fear was if you haircut their debt, bondholders in other banks are going to think, oh my gosh, they just got haircut. I'm next. They're going to panic and you're going to trigger a run on their banks. And so you're asking a very good question, but it's the issue is there's contagion between banks. So if one bank alone is in trouble and the rest of the economy is strong, a bail-in might work. But if many banks are in trouble and the economy is fragile, you can have contagion between banks. And this is where I don't think a bail-in is going to work, based on what we experienced in 2008. We're going to do some more. We're going to come back to you.
Hi, I teach high school economics and government, and lately my students have been asking me about the crisis in Puerto Rico. And they've been asking me why these people are U.S. citizens and but they don't share the rights of our states. I was wondering what you think I should tell my students when they ask me about what options their economy might have, knowing that with these limited rights.
Boy, I should ask you that question because the truth is I don't know the details of the rights of Puerto Rican citizens versus I just haven't studied it in terms of their own civic responsibilities and their own civic rights. I think given the fact that we all just went through this terrible financial crisis, our sympathy with having to bail anybody out at this point as a country is low. And so I think that there may be very good reasons. And I've read that some of the proposals in Washington are not even really bailouts, but they're being labeled bailouts. And that's enough to put the brakes on them. And so, you've asked a tough question that I don't want to fake it. I need to come back to you and give you a more thoughtful answer than I have at the moment. So, do me a favor. We'll find you afterwards and we'll get your contact info and we'll come back to your students with a better answer for what their options are. Thank you.
You made reference earlier to shadow banks and insurance companies. I want to see if you got a frame of reference you can share with us, because with all this focus and clarity that is better now than it was 8 years ago on the risk that the banking institutions and too big to fail can put on our country, do you have a frame of reference to characterize that risk? How big are the risks over on the shadow banking and insurance parts of the economy? And they're regulated, et cetera, but not to the extent and the scrutiny that the banks are seeing right now. How does that fit for you in your mind?
It's hard to know. Just take AIG for a second. So one of the largest insurance companies in the world, it wasn't their insurance business that got them risky. They basically had all these profits, and they had this financial products division that you could think of. They ran a casino backed by an insurance company, or a hedge fund backed by an insurance company. That hedge fund made lousy bets. And then all of a sudden, that hedge fund was going to bring down the whole insurance company. And so you would look at it and you'd say, well, it's just a kind of a traditional insurance company. It doesn't seem that risky. Well, this division over here ended up taking a whole heck of a lot of risks that they didn't understand, that the regulators didn't understand. And so the tough part about all of this is that, go back to what I said earlier about societies are prone to mass delusions. So things that none of us think are risky might end up being risky. And so that's why it's very hard to run scenarios like, oh, we're going to predict what's going to happen. It's a systemic risk if the thing that we never thought of happens. Because if we thought of it, we would have seen it. And so I don't know if there are big risks in hedge funds today or big risks in insurance companies that we don't understand. There's none that I'm aware of. But again, that's the nature of this. If I was aware of it, we'd already be on it.
Does it fall in your charter to regulate and manage those? Or who's your counterpart?
Well, so there are state insurance regulators. There's no national federal insurance regulator, though the biggest insurance companies, some of them have been designated as systemically important. Now, one of them, MetLife, get this. MetLife was designated as systemically important, which means they would come under the purview of federal regulations as systemic risk. They sued. They didn't like it. So they went to the courts and they said, no, we don't like the diagnosis. It's like you going to your doctor. Your doctor says you've got a very bad disease. And you say, you know what, doctor, I don't like your diagnosis. I'm going to go find another doctor until I find somebody who tells me what I want to hear. That doesn't change whether or not you're sick. That just makes you feel better. So the risk that MetLife has is based on the businesses that they run. And so I think it's a real problem that they are basically fighting it in court. And I know the U.S. Treasury said that they're going to appeal that ruling. But we need to get our arms around this, because you shouldn't just be able to opt out just because you don't like the diagnosis.
So you mentioned about mass delusion in humans. I think just as important and maybe more devastating in the financial world is moral hazard. And so I'll just give you a little stat here. Scott & Scott just topped the billion mark with their last decision that they won. They're the lawyers that are representing the plaintiffs in LIBOR, Forex rates, and now the ISDA fix that was just earlier this month, earlier in the manipulation. And your former employer, Goldman Sachs, was one of the banks of the 14 that were found guilty and had to pay the $327 million. So far, of those 14 banks, 11 of the 14 received fees of more money than have been paid in fines since the first LIBOR. And I just wondered, how is it that we can continue? The LIBOR was supposed to be the big thing. You also mentioned how headlines disappear. That LIBOR fix a few years ago was supposed to be something that we're not going to let happen again. Well, the same banks manipulated the foreign exchange rates, and now they manipulated the ISDA fix. So when is it that we've, it used to be 3 strikes, you're out. When is it for the banks that it's how many strikes and you're out?
Yeah, I mean, one of the great frustrations that many people have, myself included, is that there have really been no prosecutions of any of the fraudulent activity that took place leading up to the crisis or even since the crisis. And so right now, and this is way outside of the Fed's control. I mean, I'm not a lawyer, we're not prosecutors, we're not the Justice Department. But, the notion that if a bank does a bad deed, that they pay a fine, I mean, who are you punishing? You're punishing their shareholders. You're not punishing the management team who did the bad deeds. And so I don't know, not being a lawyer or a prosecutor, I don't know where the deficiencies are in our legal system or in the enforcement abilities to prosecute people for some of these acts. But I think what you're getting at is people need to be prosecuted. I certainly feel that way.
I guess I may not have been clear enough with my question. I wondered, when you had the notion, I saw the banner.
Let me bring a mic to you just so other people on the stream can hear you.
I brought students up to the Fed for the personal finance decathlon a couple weeks ago, and right when we got through security, hanging on the banner you have hanging there is ending too big to fail. And I think moral hazard has to be addressed with banks with regard to too big to fail. Because I think we now know they're not too big to fail. What they are is they're bailed out via moral hazard.
Well, I think ending moral hazard, so ending their incentives to just keep getting bigger and keep taking more and more risks, is at the heart of what we're trying to do at the Minneapolis Fed. I'm sorry, I confused the question. I thought you were getting at...
Because I said it confused.
It's okay. But I'm with you. So if you go back, so one of the things I'm proud of our bank is one of my colleagues and our former president, so Ron Feldman and Gary Stern, wrote the original book called Too Big to Fail in 2004, talking about moral hazard, talking about how banks have these implicit subsidies, have these incentives to get bigger and bigger and bigger, take on more and more risk because they know they're so big, the taxpayers are going to have no choice but to step in. And so that's at the heart of exactly what we're trying to address in our Ending Too Big to Fail initiative. But I just don't want to overpromise. Even if we do exactly what I want to do, this isn't going to solve the problem of why aren't some of these folks getting prosecuted when they break the law. That's a separate issue that also needs to be addressed.
I have a question regarding the too big to fail, and you mentioned the complexity. In my mind, it's not too big to fail, it's too big to regulate. What are you doing to take on the off-balance sheet risk into that equation of the risk that these large institutions bring to the system?
Yeah, that's a great point. So we saw that, by the way. So in 2008, and this is why some of the plans that are currently in the works, I don't have confidence in, because sometimes things look like you've separated risk and you put the risk over here so the bank isn't on the hook, but then all of a sudden they really are on the hook. So for example, in leading up to the crisis, banks, some of the big banks had issued things called structured investment vehicles, which is called a SIV. And the SIV was supposed to be an off-balance sheet item where they put a bunch of risky assets, or they didn't even think they were risky, but they ended up being risky. And then when the crisis hit, technically they weren't supposed to be on the hook, but they said, oh my gosh, we have to go bail these out because we're going to take a reputational risk if we allow our clients to fail in that SIV. And so what ended up happening is reputational risk pierced this legal barrier. And so you're right, we have to look at more expansively than just what's on the books of these banks. What are some of the other risks that they may not even realize that they're taking? And that's why, if we go back to something Annie asked about earlier, which is if you were to tax debt in the financial system, it might be a way to address some of these risks that aren't strictly on the books of the banks. They might be over here. They might still be risky for the banks and for the rest of us. We need to make sure we address that too. So we're looking at ways to try to do that. It's hard to come up with one answer that solves all of these problems. It may end up being a combination of some of these solutions.
Are there any things like those SIVs that you're aware of now that kind of are making you skittish?
The tough part is they renamed them. Okay. They call them different things, and so they look different, and maybe they have a different wrapper around them, but it's the underlying behavior that we have to be watching out for. And so, again, nothing jumps out at me at the moment. But I'll give you an example of how hard it is to predict some of these things. Since 2008, All of us have had our eyes wide open looking for big shocks in the economy. And I don't know a single person who predicted oil going from 150 to 30. That's a huge shock. Now, it's a good shock for drivers. It's a bad shock for oil producers. But it's a huge swing in the price of a really important part of our economy. And we missed it. So we need to start by assuming we're going to miss the next one. So let's build enough resilience so the economy doesn't crater when we miss it.
I've got a question about the too big to fail, and to let you know, I'm involved with the small bank community, and so even if it's a rumor that you're a supporter of small banks, I still appreciate it. Hopefully it's true. And I agree that the too large to fail of the large banks does need to be addressed, but to call those large banks a bank the same as you call us a bank, there's no comparison whatsoever. And it's more the investment banks that caused the problems, the synthetic securities they were selling, and things like that. So it needs to be addressed. But in defense of the large banks, how do you handle it internationally? Most of the U.S. banks, I think there's only 2 or 3 in the top 10 in the world. If you try to regulate the U.S. banks, what happens with the rest of the world? Or do those U.S. banks just migrate to become world banks instead of U.S. banks?
Yeah, it's a good question. So, my view is we have to focus on what we can control. You're right. Some of the too big to fail banks are not just American banks. They're European banks. They're Asian banks as well. And we can't control yet. We can't control what they're going to do in Europe or what they're going to do in Asia. My view is if we can address our banking sector, come up with one set of rules for any bank that wants to do business in America. They need to follow our rules if they want to do business here. And maybe we can show the world, here's a way of addressing this problem, and you can still have a robust economy. One of the presenters at our symposium, the presenter from MIT, pointed out that American banks were not so concentrated 20 years ago, and yet we saw pretty strong economic growth. And so this notion that you have to have really concentrated mega banks in order to have economic growth is just not borne out by history. And so if other countries want to take huge risks, we can't stop them, but we should do what's right for America. The other related point is sometimes businesses or sometimes big banks will say, well, big American companies need global banks. So think General Mills, think Boeing, think Cargill. They do business all around the world. Don't they need banks that do business all around the world too? And I don't find that argument compelling, because the biggest American companies manage thousands of suppliers all around the world. You're telling me they can't manage a few dozen banking relationships around the world? Of course they can. Will it be a little bit less convenient? Sure. But if we're all much, much safer for it, is it a good trade? Probably.
In the effort to determine a reasonable size for banks, none be too big to fail, would you describe for us the problem, if any, about the notational value of derivatives, in the fact that Congress made a policy saying that derivatives aren't insurance, and so whatever you collect in your fee, which is really a premium, there's no reserves posted. Is that going to be tolerated very much longer?
Well, it's a big, you're asking a good question. It's a very big issue. The notional value, I don't know the number off the top of my head, but it's many tens of trillions of dollars. I don't know if it's 50 trillion or 100 trillion, but it's in the many tens of trillions of dollars are the theoretical exposure that these banks have to some of these derivative contracts. Now, they will argue, well, yeah, we have exposure in one direction over here, and we have offsetting exposure here, so the net is much, much smaller. There's some truth to that until the derivatives behave and the market does something they weren't expecting. Then all of a sudden the risks end up being correlated instead of being offsetting. And so that is absolutely a factor into trying to assess, it's not just size, it's complexity, it's exposure. After the financial crisis, I hope more than anything that we all have learned a little bit of humility, that we may think we have all the answers and we don't, and we need to assume that we don't, and we need to prepare for the worst, don't just hope for the best. And so I'm with you. Derivatives are a big part of the complexity, why it's hard to analyze and understand these risks. And again, the biggest banks have very sophisticated computer models of how all this stuff is supposed to work. And it works great until it doesn't. and then it really doesn't, and then they're in trouble, and then they have to turn to the taxpayers.
I just want to interject a question here, and we'll take one from you as well. But everything you're doing on this topic, you're going to be holding these symposiums all year long. At the end of the year, you hope to have some sort of document of, clear recommendations,
yeah.
right? Are you currently courting anyone in Congress to sponsor something?
So the Federal Reserve, we're not allowed, and we do not lobby Congress. So we just don't. Our view is we're happy to educate members of Congress if they have questions. So I have received letters from members of Congress who said, I want to understand what you're doing. Could you please inform me of this or that? Or if their staffs reach out to us, we're happy to spend time educating their staffs on what we're doing. But there's a pretty strict limit that we're not in the business of lobbying Congress. What we're trying to do is educate the American people to be as informed as possible, and then they can choose what to do and what they think is appropriate.
How interested are these parties in what? I mean, do you think that there may well be some sort of proposal?
I think so. I mean, I look. This is not a partisan issue. Right? There are people on both sides of the aisle who feel like we need to do more, and there are people on both sides of the aisle who feel like we don't. And so, at least I take some comfort from the fact that we're not picking sides. We're not weighing into politics. We're doing the analysis. We're educating people, putting it forward. At the end of the day, it's up to the people through their elected representatives to decide what they want to do.
You make the point that you're nonpartisan. I mean, there is no secret, though, that you're a Republican, called yourself a free market Republican. It's probably surprising to some people to hear you say things like, hey, you multinational corporations, if this inconveniences you, what I'm proposing, too bad. And there may be some limits put on economic growth as a consequence. Maybe lending would be, credit would be more expensive. I just wonder, would the Neel Kashkari of, 2005 be surprised at what the guy today is proposing?
Probably. But, when I look back at the financial crisis and I criticize us, well, what did we do wrong? The biggest mistake we made, in my opinion, is that we were always too slow. Because I was a Republican working for President Bush. We were a free market conservative administration that hated the idea of intervening in markets. If you took a risk, you bear the consequences of that risk. Nobody owes you anything. So we were always late. And we were dragged to the bailout table where finally it got so bad that we had no choice but to step in and ask Congress to use taxpayer money to stabilize the crisis. And so I feel like I still strongly have my free market preferences. But I also learned the hard way that there are limits to truly unregulated free markets, and that we need to preserve the vibrancy of our economy, the risk-taking, the entrepreneurial spirit, absolutely. But we need to not have a system where one sector of the economy can devastate everything for everybody. I like the idea of Silicon Valley. Let them make their bets, and if they swing and miss and they fail, they're the only ones that get hurt by it.
So risk-taking may be okay in certain sectors and less so in lending?
Yeah, risk-taking should be okay in financial services as well, but we need a financial system that's resilient enough to allow banks to make mistakes and not bring down the rest of the economy with them. Allow that bank to fail, allow their shareholders to get wiped out, their management team to lose their jobs, but not bring down the rest of the economy.
Getting the signal here, so I think we have time for one last question.
Thank you. There's 10,000 people every day on average turning 65, and they're looking for income. And one of the reasons I think there's CIVs and CMOs and all these crazy derivative instruments is because people need income, and there's demand for it. So I'm just wondering, isn't that driving a lot of this? And that they wouldn't create products that there isn't demand for. And there's demand for it because rates are as low as they are. And also, isn't that just driving, my opinion is that banks are so big because that's where people are voting with their money. It's not because they're maniacal instruments trying to take over the world. It's because that's why people are voting with their money. So how do you control that, and what do you do with that?
Sure. Well, first I would push back respectfully on the idea that these complex structures are coming because we have a low interest rate environment. These complex structures were born and blew up in the mid-2000s when we had more normalized interest rates. So these didn't just come about after the crisis. They contributed to the crisis in the first place. And then if you look all around the world, this is the part about how economists don't understand everything. Interest rates around the world have been gradually declining over the last 30 years, real interest rates, not because of central banks. Central banks just manage things on the margin around the trajectory the economy is already headed. That's happening for broader macroeconomic forces because of aging societies around the world, various trade policies, various savings policies, et cetera. So for a lot of broader macroeconomic factors is why the interest rates have been low. But in terms of people voting with their feet, you're right. A lot of people have been putting their money in the biggest banks because they feel like the biggest banks are the safest. Because we just showed them that they are. Because it was the biggest banks that got bailed out. And so if you were a borrower, you could sleep well at night. You know, I'll give you an example. In 2008, in the worst moments of the crisis, I thought to myself, oh my God, I'm going to lose my house. Because my savings was in a money market account. And I'm like, those money markets are toast. And I thought for a second, maybe I ought to move my money from my money market account to my Bank of America checking account. Because in my heart, I'm like, well, Bank of America is probably going to get bailed out. Now, I didn't do that because it wouldn't have been fair because I had information, inside information into what we were doing. So I said, if I'm going to lose my house, so is everybody else. So I just have to go down with everybody else. But the fact of the matter is, we have now, if there was moral hazard before, there's way more moral hazard now because we just showed the world that if the biggest banks run into trouble, the American people are going to step in to protect them. So I'm not surprised that homeowners and borrowers are moving to the biggest banks because we've already told them that they're the safest. That's why I think we need to take bold reform, solve the too big to fail problem, and put all banks on a level playing field. And then borrowers can decide where they want to put their money just based on the merits, not based on implicit government guarantees.
All right. Well, I think we need to wrap it up there. Thanks so much
Annie,
for...
thank you so much as well. Thank you all. I really appreciate it.